The Great Recession wasn't just a market crash, it was a wake-up call. One day, people felt financially stable. The next, jobs were gone, home values crumbled, and retirement accounts took a beating. Anyone who thought they were prepared quickly found out if they actually were. According to Stanford research, the average American household lost a third of its net worth during the downturn. Some learned valuable lessons and made changes. Others repeated the same mistakes, setting themselves up for trouble in the next crisis. This is about financial lessons that still matter today. Things that can protect your money, build real security, and keep you in control no matter the economic climate. Check out the full details by visiting the link in the description. The Great Recession, a brutal financial reality check. The Great Recession hit hard between 2007 and 2009, leaving financial devastation in its wake. It started with a housing market collapse, triggered a banking crisis, and spread like wildfire through the economy. Millions lost jobs, businesses shut down, and retirement savings took a nosedive. The stock market crashed, home values plummeted, and suddenly, what seemed like financial stability turned into survival mode. It wasn't just a rough patch, it was the worst economic downturn since the Great Depression, and its lessons still matter today. Number 1. An emergency fund is non-negotiable. Losing a job with no savings is like jumping out of a plane without a parachute. The landing is going to hurt. Most experts say to keep 6 to 12 months of expenses in cash. That's fine as a general rule, but real life is messier. Expenses fluctuate and one-time costs can crush a budget. My approach is to take a rolling 24-month average of spending, add in big-ticket replacements, like a new roof or car repairs, divide it over 5 years, and throw in a buffer based on risk tolerance. That way, the number isn't just a guess, it's based on what life actually costs. If that sounds complicated, start with 6 months of savings and adjust as you go. The key is making sure you're covered when the unexpected happens, because it always does. Number 2. Job security is a myth. Diversify your income. A steady paycheck feels safe until it isn't. The recession wiped out millions of jobs, and people who relied on a single income source got blindsided. Having multiple income streams like side hustles, freelance work, rental income, dividends means not being completely at the mercy of an employer. Even if you love your job, companies cut costs when times get tough, and employees are always on the chopping block. One income stream is a vulnerability. 2 is better. 3 or more means real security. The goal isn't to work 24/7. It's to build a financial safety net so you're never backed into a corner. Number 3. Living below your means is key to financial resilience. Spending every dollar you make is fun until it isn't. When the economy tanks, people who live paycheck to paycheck have no cushion. The ones who stayed afloat during the recession were the ones who kept their expenses lower than their income. This isn't about extreme frugality, it's about smart spending. Prioritize the essentials, cut the waste, and make sure there's always a gap between what comes in and what goes out. That gap is what gives you options. It lets you invest, save, and survive financial shocks without panicking. When the next downturn hits, the people who spent every dime will be the first to struggle. Don't be one of them. Number 4. Debt can be a financial death trap. Debt feels manageable when things are good. Then the economy crashes, income dries up, and those monthly payments don't stop. A lot of people learned this the hard way when they lost their homes, cars, and financial stability in the recession. The worst debt is high-interest consumer debt, credit cards, payday loans, anything that keeps you trapped in a cycle of paying for past purchases. Mortgage debt is trickier. If your house is affordable and you have job stability, it's fine. But stretching to afford a bigger home than you need is asking for trouble. If you're taking on debt, always ask, what happens if my income drops? If the answer is disaster, rethink the decision. Number 5. Adjustable rate mortgages, ARMs, can be dangerous. A lot of people signed up for adjustable rate mortgages because the initial payments were lower. Then interest rates reset, payments shot up, and suddenly their dream home became a nightmare. ARMs work if you fully understand the risks, but most people don't. A fixed-rate mortgage means predictable payments and long-term stability. If interest rates drop later, you can refinance. If they go up, you're protected. The people who took fixed rates before the recession had one less financial fire to put out. The ones with arms? Many lost their homes. Betting on low interest rates staying low is a gamble. And when it comes to housing, gambling is a bad idea. Number 6. The stock market rewards long-term investors. The S&P 500 dropped over 50% during the recession. Some panicked and sold at the bottom. Others held on, kept buying, and came out ahead when the market recovered. The lesson? Timing the market is impossible, but staying in it works. Stocks go up over time, even if they take some brutal hits along the way. If you're investing for the long run, short-term crashes don't matter. What matters is having a strategy, sticking with it, and not making emotional decisions when prices swing. The people who stayed the course made money. The ones who bailed locked in losses. Simple as that. Number 7. Asset allocation and diversification matter. Going all in on one type of investment is asking for trouble. Some people were 100% in stocks and watched their portfolios collapse. Others thought real estate was a guaranteed win and got crushed when home values plummeted. A balanced portfolio spreads risk. Stocks for growth, bonds for stability, cash for liquidity, maybe some real estate or alternative investments for extra diversification. The exact mix depends on your risk tolerance and goals, but the key is not having everything in one place. Diversification doesn't prevent losses, but it does prevent total financial ruin. That's the difference between surviving a downturn and getting wiped out. Number 8. Real estate isn't always a safe investment. People used to say real estate prices always go up. The Great Recession proved otherwise. Home values crashed, and millions of people ended up underwater on their mortgages. Buying a house is fine if it makes sense financially, but assuming it's a guaranteed wealth-building strategy is a mistake. The real estate market has cycles, just like stocks. Buy smart with a long-term plan and a financial buffer. Stretching to afford a home you can barely pay for is a risky move. If you're going to buy, make sure you can afford the payments even if the market tanks. And if you think renting is throwing money away, remember, negative equity is worse. Number 9. Credit scores can make or break you. A bad credit score doesn't seem like a big deal until you need a loan. When the economy crashed, people with strong credit got better rates, better deals, and better opportunities. The ones with bad scores? They got denied or stuck with sky-high interest rates. Keeping a good score isn't complicated. Pay bills on time. Keep credit utilization low. Don't close old accounts without a reason. And don't take on debt you can't handle. In good times, a high credit score saves money. In bad times, it can be the difference between getting approved or getting stuck with nowhere to turn. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. Number 10. Government bailouts don't help the average person. During the recession, big banks got massive bailouts while regular people lost homes and jobs. If that doesn't tell you where priorities are, nothing will. Expecting the government to save you in a crisis is a losing bet. There might be assistance, but it's usually slow, full of hoops to jump through, and not nearly enough. The safest plan is one that doesn't rely on outside help. Build savings. Keep debt low. Have multiple income streams. Take control of finances so no politician, corporation, or economic shift decides your future. Number 11. Healthcare costs can ruin finances overnight. Medical bills pushed millions into bankruptcy during the recession. Some had no insurance. Others had policies that barely covered anything. Either way, one hospital visit wiped out their savings. Healthcare is expensive, but skipping insurance is even riskier. A high-deductible plan with an HSA is a good middle ground, lower monthly costs with tax-advantaged savings for medical expenses. Health issues don't wait for a good economy. Having a plan in place keeps a medical emergency from turning into a financial disaster. Number 12. Inflation and economic downturns can happen together. People assume inflation only happens in a booming economy. The recession proved otherwise. Prices fell in some areas, but essentials like food and healthcare kept rising. That squeezed budgets even more. The lesson? Keep a mix of assets. Cash for flexibility. Investments that grow faster than inflation. Hard assets that hold value. A plan that only works in good times isn't a plan, it's wishful thinking. Number 13. Passive income provides stability. Jobs vanished during the recession, but rental income, dividends, and online businesses kept paying. Not all passive income is truly passive. Rental properties still need management, and investments have risks. But having income sources that don't rely on clocking in every day creates real security. It takes time to build, but the earlier you start, the easier life gets when a downturn hits. Money coming in without working for it is the closest thing to financial freedom. Number 14. Recessions are a great time to invest, if you're prepared. The market tanked, people panicked, and the ones who had cash ready bought assets at fire sale prices. The best investment opportunities come when others are too scared to take them. But that only works if you're in a position to act. Keeping cash on hand, avoiding over-leveraging, and having a plan before the market crashes means being ready when the time comes. Everyone says they want to buy low and sell high. Few actually do it. Number 15. Social safety nets aren't always reliable. Unemployment benefits ran out. Assistance programs got overwhelmed. People who thought there would be help found out the hard way that safety nets have holes. That doesn't mean ignoring available resources, but it does mean not depending on them. A strong personal financial safety net is always the better bet. Savings, diversified income, and smart planning will always beat hoping the system comes through. Number 16. Financial education is a lifelong investment. A lot of people had no idea how mortgages, interest rates, or the stock market worked until it was too late. Financial literacy isn't just about avoiding mistakes, it's about taking control. Learning how to invest, manage risk, and grow wealth isn't something to put off. It's something to make a priority. Those who understand money make better decisions. Those who don't end up at the mercy of those who do. Number 17. Too big to fail. Companies can still collapse. Lehman Brothers was massive, until it wasn't. Other companies that seemed untouchable barely survived. Putting blind faith in any institution is a mistake. That includes employers, banks, and even investment firms. Spread out risk. Have a plan if something collapses. Nobody cares more about protecting your money than you do. Number 18. Retirement plans aren't bulletproof. 401k took a beating during the recession. People who thought they were set for retirement saw their balances get cut in half. Some pulled their money out at the bottom and locked in losses. Those who kept investing and stuck to a solid plan recovered. Retirement investing isn't about reacting to every market dip. It's about consistency, smart asset allocation, and having a strategy that holds up long-term. Number 19. The best time to plan for a crisis is before it happens. Nobody thought the recession would be as bad as it was. Then it hit, and most weren't ready. Planning after a crisis starts is like putting on a seatbelt after a crash. Too late. A strong financial plan accounts for worst-case scenarios before they happen. Savings, insurance, diversified income, and a flexible budget aren't just for peace of mind. They're what keep financial disasters from turning into personal disasters. Learn from the past, protect your future. The Great Recession was brutal. It wiped out savings, crushed dreams, and exposed a lot of financial weaknesses. But it also left behind lessons that still matter today. Those who adjusted and made better choices came out ahead. Those who didn't repeated the same mistakes. The next downturn isn't a question of if, it's when. The best time to prepare is before it happens. Financial security isn't about predicting the future. It's about being ready for whatever happens. Want to be in a stronger position next time the economy tanks? Apply these lessons now. Thanks for watching, And if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.